Hello everyone, I'm Brett Carleton coming to you from the offices of Heritage Wealth Management here in Houston. I want to take just a few minutes and talk to you about the first quarter of 2023, and I would say that the story has to be the U.S. Federal Reserve Bank, which really has been the story over the last 12 months and really over the last 3 years. But before I do that, I want to take just a minute and talk to you about the Federal Reserve Bank and exactly what their mandate, what their responsibility is. The Federal Reserve was created over 100 years ago, and as we talk about it, it's often referred as the Fed, but probably the most powerful financial institution in the world. And their mandate is price stability and really financial stability within the U.S. economy, and they've also added a third mandate here recently, full employment. And price stability has become very important here over the last 12 to 18 months as inflation has been just rampant, not just here in the U.S., but in the world. And so what the Federal Reserve will do is to try to bring down inflation. They'll try to slow the economy down. And the way they do that is through the federal funds. And that's loans to banks and loans between banks. And what the Federal Reserve will do is they'll raise the interest rate that these institutions charge each other for these overnight loans. And so what happens is they raise the rate there, it trickles down through the economy, and ultimately we then pay more for interest on any loans that we have. And as they continue to raise rates, as they have been doing over the past 12 months, there's less demand for new money because the cost of capital becomes more expensive. And we've really seen this in housing over the last 7, 8, 9 months. You can think about the boom in housing during the pandemic, and what's happened here as we got late into the last summer and even in the fall is housing just died. Mortgage rates went from 2.5% to about 7.25%, 7.5%. And so by raising rates, they just basically have just crushed housing. The goal here is not to crush the economy, but to slow demand, because through less creation of new money, i.e. loans, we begin to see a slowing of the economy, a tightening of financial conditions, and we've seen that. We've seen that here recently with the failure of a couple banks as they had tremendous growth during the financial crisis. Then as financial conditions got real tight and there was a run on those banks, they basically were taken over by the FDIC. So the Federal Reserve is there to try to create financial stability, to manage inflation, and to keep employment hopefully as full as possible. Right now they're in the process of trying to rein in inflation, and we're seeing that. Inflation has continued to go down from a peak of, I believe it was July of last year. It continues to go down, and even some of the stickiest components of that, which would be rent, are beginning to come down month over month. So I think what they're doing is working. But what we're starting to hear is many economists, and I would be one that would be in this camp that would say, let's just stop raising rates. Let's just let the interest rate increases they've done so far, let that take effect, and let's see what happens here. Because the number one cause of recessions historically in our country is the Fed raising rates too high, causing the economy to slow too much to where we actually have a contraction. So I think with the most recent 2 bank failures, the Fed may pause and allow this to sort of work through the system, because each time we raise rates, or the Fed raises rates, it takes 6 to 9 months for that to trickle through the economy and to really have the effect that they intended. So we are just now really beginning to see what they did in March of last year, because that was the first interest rate increase they had. So I wanted to just touch on that just for a minute so we'd have a better understanding of why is the Fed doing what they're doing. And really it's to try to slow the economy, slow demand, so that inflation will continue to come down. I've talked a bit about in the past this great normalization. And if we think about the last 3 years, because it was 3 years ago in March here that we shut the global economy down. Think about it. We shut the global economy down. Then shortly thereafter, Western economies began to just pour money into their economies, hand money out to people. And with the shutdown of the global economy, we had supply chain issues. So there were shortages of supplies. So we had people with excess cash chasing a shortage of supplies, that is inflation 101. So as we've seen inflation spike, demand spike, we're in this process of getting really trying to get people back into the jobs they were in before the pandemic. Think about it, when 20-something million people were laid off in the United States, millions of them went to work for Amazon and places like that. Well, we've got to get those people back into the service sector, and that's what we've seen happen. So we're beginning to see a normalization in the employment sector. We're beginning to see a normalization in monetary policy as the Federal Reserve has been able to pull some of that liquidity out of the system that they pumped in during the pandemic, and we're beginning to see inflation come down. And that's, I think, what we'll continue to work through this year, and hopefully the Fed won't have gotten rates so high they dump us into a recession. I think if they do push us over the edge into recession, I don't think it would be a deep or a long-lasting recession because consumers are still relatively flush with cash, this money that they saved and this money that they received during the pandemic. Banks are actually relatively strong in spite of these two recent bank failures. And businesses, their balance sheets are strong, earnings are still strong, even though there's an expectation they may come down. So with those factors, we typically don't have a deep recession. So I'm not going to sit here and predict whether or not we're going to have one, but I think there's a possibility that we could tip into recession. And what I'd like to finish with is just, how does this impact us as investors? How does this impact our plan? You know, right now we're seeing higher interest rates on our safer investments, our fixed income type investments, our bonds, things of that nature, than really we've seen this entire century. So what we can expect is higher returns from our safer component of our portfolios. Now the stock side, I do expect more volatility as we move through sort of the last phases of this Fed tightening cycle. I don't necessarily predict anything really bad, but I do expect more volatility. So what do we do as long-term investors? We use these opportunities to do some rebalancing, maybe some minor tweaks to the portfolio, but we've got a plan in place. We don't throw the plan out because of what the Fed is doing. This is a normal part of the business cycle. It's something that we anticipate, that we expect, and we will move through this into the next expansionary time. So we just have to be patient as we go through this year. Our investments will continue to compound and grow, and we will be buying more shares as we move through the remainder of this year. So I want to say as I finish this is if you find these videos useful, let us know. We'll do more of them. We have also attached a couple of slides. One is just of the federal funds rate going back to 2000, and you can see how dramatic this increase is. And the second article is just something on Silicon Valley Bank that Fidelity wrote up, and it's an interesting story as to what happened to Silicon Valley Bank. And I think it also helps to explain how they're not systemic to the overall financial system in our country. But I think on that, I'll end it for today. And as always, we welcome any comments you have. And thank you for your time today, and have a wonderful afternoon.